We are covering the 7 top actively traded stocks that are bullish today. While watching price actions, let us inform you our review on NAK. Northern Dynasty Minerals Ltd has recently made waves with its response to a major executive order from President Donald Trump that aims to boost American mineral production. The order, issued on March 20th, focuses on securing a stable and predictable supply of critical minerals essential for defense, technology, and infrastructure. For Northern Dynasty, this could be a game changer, especially when you consider that the company's flagship asset, the Pebble Project in Alaska, is home to one of the world's largest undeveloped copper deposits, along with significant amounts of gold, molybdenum, silver, and rhenium. Rhenium, in particular, is a mineral that's used heavily in military applications, making the Pebble deposit even more strategically important. The U.S. government's push to expedite approvals for domestic mining projects could directly impact the Pebble project, potentially speeding up regulatory processes that have been slow in the past. That's a huge positive for Northern Dynasty, as it could bring the Pebble project closer to development, which in turn would open the door to significant economic benefits for Alaska, including high-paying jobs and increased tax revenues for the state and U.S. government. Given that the Pebble deposit is seen as a major resource for the U.S. mining sector, this executive order could provide the kind of momentum Northern Dynasty needs to move its project forward. If the federal government follows through with its promise to fast-track mineral production, we could see a much quicker path to monetizing the Pebble deposit, which is likely to translate into strong upside potential for investors. For those watching Northern Dynasty, this is definitely a development to keep an eye on, as it could have significant implications for the company's stock performance in the near term. Our review on CLSK. CleanSpark Incorporated is making some serious moves in the Bitcoin mining space with its extensive network of data centers across the U.S., including locations in Georgia, Mississippi, Tennessee, and Wyoming. The company's capacity is impressive, with about 853 megawatts of contracted power. That power fuels a fleet of 188,500 Bitcoin mining machines, generating a hash rate of around 27.6 exahashes per second, which is a huge amount of computational power. Recently, CleanSpark has been benefiting from a couple of key developments in the sector. First, the company's focus on efficiency stands out. Its fleet operates at a solid 21.94 joules per terahash, which helps it keep operational costs in check. Efficiency is crucial in this space, as mining costs can fluctuate heavily depending on energy prices and the overall mining difficulty, which keeps investors on their toes. What's also been exciting for CleanSpark lately is the broader trend in the market. With the increasing interest in Bitcoin and blockchain technologies, the mining industry is getting more attention. Bitcoin's price movements can heavily impact mining companies, and CleanSpark has been able to capitalize on its efficient operations. This combination of scaling its operations while keeping efficiency high places it in a solid position for growth, especially with the company's expansion plans across the U.S. For investors, the key takeaway here is that CleanSpark is well-positioned in a market that's both volatile and rapidly evolving. As long as the company continues to manage its energy usage efficiently and expand its infrastructure, it could be set up for long-term success, especially if Bitcoin prices keep trending upward. CleanSpark is definitely one to keep an eye on, especially as the market continues to mature and the demand for reliable, efficient mining operations grows. Our review on IONQ. IONQ Incorporated has been on the radar lately, and for good reason. This company is all about pushing the boundaries in the quantum computing space with its advanced systems like the IONQ Forte and IONQ Forte Enterprise, both packing a solid 36 algorithmic qubits. These machines are designed to tackle some of the toughest commercial and research problems, and the fact that IONQ has made these systems available through major cloud platforms like AWS, Microsoft Azure, and Google Cloud Marketplace speaks volumes about their ambition to make quantum computing as accessible as possible. Recently, IONQ stock saw a pretty exciting jump, up around 17% in just one day. So what's behind that spike? Well, quantum computing stocks have been bouncing back into the spotlight, especially after NVIDIA's Quantum Day event. At that event, NVIDIA's CEO admitted that his earlier stance, claiming that it would take decades for quantum computers to be truly useful, was off base. That shift in perspective has lit a fire under stocks in the quantum computing sector, including IONQ, which has benefited from renewed investor enthusiasm. It's not just about NVIDIA changing its tune either. IONQ is in a good spot for a couple of reasons. First, it's one of the frontrunners in the field, constantly pushing out more powerful systems. Second, its model of offering quantum computing as a service, QCS, through the cloud means it can tap into a broader market, offering access to cutting-edge technology without requiring customers to build their own infrastructure. This flexibility is a key selling point for businesses looking to explore quantum computing without committing to huge upfront investments. Of course, like all tech stocks, especially in a volatile space like quantum computing, IONQ stock can swing dramatically based on news and hype. After a tough pullback earlier this year, it looks like bulls are back in control for now. If the momentum from the broader rebound in U.S. stocks and continued excitement in the quantum space holds up, IONQ might just continue to see that upward trajectory in the short term. But, as always with this kind of tech, investors will need to keep an eye on any major developments in the quantum landscape that could shake things up. Our review on RIVN. Rivian Automotive Incorporated has carved out its niche in the electric vehicle space with its R1 platform, which includes the R1T pickup truck and R1S SUV, and its electric delivery van, EDV, in collaboration with Amazon. So, with all this development, how's Rivian holding up in the broader EV race? The reality is Rivian's been playing a bit of second fiddle in the EV space lately. The company still faces a tough road ahead, particularly when stacked up against Tesla, which continues to dominate the market with its massive brand recognition and established infrastructure. While Rivian's vehicles have gotten love, especially from off-road enthusiasts, the company has struggled to establish mass market appeal. That said, Rivian's got some interesting cards up its sleeve. Beyond the consumer market, its work with Amazon on the EDV could be a significant long-term revenue stream. Delivery vehicles are crucial to Amazon's eco-friendly push, and Rivian's role in that partnership could drive solid business growth. Rivian also has its FleetOS platform, a subscription-based service for managing vehicle fleets, which offers recurring revenue and taps into fleet electrification. If the company can capitalize on this and expand its commercial offerings, it could secure a stronghold in that sector. Despite the competition, Rivian's backing by Amazon and its commitment to services like maintenance and software subscriptions gives it a unique edge. Still, as the EV space grows, Rivian faces stiff competition to rise above being a bit player and claim a leadership spot. Investors should watch how well Rivian can scale production, keep up with trends, and ensure its collaborations, like with Amazon, continue to play out as planned. Our review on RIOT. Riot Platforms Incorporated is making some big moves in the Bitcoin mining world, and investors are taking notice. The company, which runs Bitcoin mining operations in Texas and Kentucky and has a strong foothold in electrical engineering, just announced a proposed $185 million acquisition deal. So what does this mean for Riot's future? Well, this acquisition is centered around assets owned by Rhodium Encore LLC, at Riot's Rockdale facility. For $185 million, Riot is set to gain full control of rhodium's 125 megawatts power capacity and operational assets. This would not only expand Riot's mining capacity, but also consolidate its energy usage, which is a big win in an energy-heavy industry like Bitcoin mining. Riot is also walking away from ongoing litigation with rhodium as part of the settlement deal, which clears the path for smoother operations moving forward. What makes this deal interesting for investors is that Riot is effectively buying a ready-to-go facility, complete with ASIC miners, which could instantly ramp up its mining output. Riot is paying a mix of cash and stock, and this strategic move could significantly boost the company's mining capacity while resolving some lingering legal issues. The deal's still pending court approval, but if it goes through, it'll add a strong new revenue stream and give Riot more control over its energy needs, something crucial in the volatile world of Bitcoin mining. On top of that, Riot has a solid cash position, with nearly $278 million in cash and over $134 million in marketable securities, giving them ample room to expand further or weather any market swings. This deal, once finalized, could prove to be a game-changer for Riot as it continues to scale its operations. Investors seem optimistic, but they're also keeping an eye on the court's approval and final terms. If everything falls into place, this could be a big win for Riot and its stock performance. Our review on BITF. Bitfarms Ltd is making moves in the Bitcoin mining space with its vertically integrated approach, running 11 mining farms across Canada, the US, Paraguay, and Argentina. The company handles everything in-house, from the mining operations to the electrical engineering and even technical repairs, giving it a lot of control over its processes. Recently, Bitfarms has been focusing on expanding its mining capacity and improving its efficiency through its proprietary data analytics system. This system helps ensure the company's operations are running smoothly and with minimal downtime, which is crucial in the high-stakes world of cryptocurrency mining. The company earns revenue by mining Bitcoin 24/7 and selling computational power to mining pools under a full pay-per-share (FBPS) rate. In terms of stock performance, Bitfarms has been seeing some positive momentum as investors are excited about its ongoing global expansion and efficiency improvements. The company's ability to scale up its mining operations and maintain high uptime gives it a competitive edge in a market that's all about maximizing output while keeping costs low. For investors, Bitfarms is one to watch as it continues to grow its operations across multiple regions, and its vertically integrated model provides a unique level of control that could help it weather the volatility that often hits the crypto market. If Bitfarms can keep hitting its operational targets, it could lead to strong revenue growth, and that might translate into a more robust stock performance moving forward. With global expansion, a solid business model, and a focus on efficiency, Bitfarms looks like it's setting itself up for long-term success. Our review on LUNR. Intuitive Machines Incorporated is making its mark in the space industry, focusing on lunar exploration and infrastructure services. The company operates across several sectors like lunar access, orbital services, and space products, providing everything from propulsion systems to lunar mobility vehicles. The stock has been moving higher recently after the company reported strong financial growth, despite missing some analyst revenue expectations. For the fourth quarter, Intuitive Machines posted $54.66 million in revenue, up 79% year over year, though it fell short of the $55.77 million estimate. The company also highlighted a record backlog of $328.3 million, reflecting strong future growth potential. Despite some setbacks like technical issues during its IM-2 lunar mission, Intuitive Machines remains financially secure with $385 million in cash as of March 10th, up significantly from the previous quarter. Looking ahead, Intuitive Machines has set a revenue target of $250 million to $300 million for 2025 and expects positive adjusted EBITDA by the end of that year. The company is positioning itself for long-term growth, with a focus on expanding its reach beyond NASA and into broader markets. While the stock has taken a hit recently, dropping over 50% in the past month due to mission challenges, the company's solid financials, strong backlog, and strategic growth plans suggest it's still a player to watch in the space sector. For investors, the key takeaway is that Intuitive Machines has strong technology and a clear path forward, even if there are some bumps along the way. If they can overcome recent mission setbacks, they might see those investments pay off as the space industry continues to expand. Please subscribe, give the video a like, and watch more from our playlist. Thanks.